If you have ever sent an email that arrived before you'd finished thinking about what to write next, or watched a web page load in under a second, or dialed long distance for less than $1 a minute without a second thought, you have used something this company built, even though you almost certainly never knew its name. That low hum of a data center at night. The click and hiss of a modem finding its connection in the mid-1990s. The particular silence of a fiber optic cable doing, invisibly, the work that used to take a wall of copper and a room full of switchboard operators. That was them. At its peak, in the summer of 1999, this company was worth $180 billion on paper, the 14th most valuable company on the planet, more valuable than General Motors, more valuable than most countries' entire stock markets. It employed more than 80,000 people. It was the second largest long-distance telephone carrier in the United States, behind only AT&T, and through a subsidiary called UUNET, it carried a share of the entire world's internet traffic. That most people, even at the time, had no idea existed. It had grown from a single leased phone line into an empire by buying more than 75 other companies in under 2 decades. They survived being a 4-man startup with $650,000 in borrowed money and no experience in telecommunications at all. They survived a near collapse in their first 2 years, when the founders themselves had to step aside and hand control to somebody who had never run a telecoms company before. They survived years of being outspent and outmarketed by AT&T, the company that had dominated American long distance for a century. They survived a bidding war against British Telecom for the prize of a company 4 times their own size, and won it. They survived a price war in long-distance rates through the 1990s that destroyed smaller resellers every single year. They adapted, they bought, they merged, they absorbed more than 70 other companies one after another. And on paper, they never once reported an unprofitable quarter. And then, in the summer of 2002, the company that Wall Street had called unstoppable was revealed to never have actually earned a profit at all, not for the 2 most recent years anyone could check. How does a business worth more than most nations, one that employed accountants by the thousand and was audited every single year, end up having invented $3.8 billion of its own income out of nothing? And what does it actually look like inside an ordinary office building in an ordinary American town, when hundreds of ordinary people know something is deeply wrong and keep coming to work anyway? Let's start at the beginning, in a coffee shop in Mississippi, in 1983. The idea for this company was not written on a business plan. It was written on a paper napkin in a coffee shop in Hattiesburg, Mississippi in 1983 by a man named Murray Waldron. Waldron and a businessman called William Rector had noticed something. The federal government had just forced the breakup of AT&T's telephone monopoly, and for the first time, small companies could lease long-distance lines wholesale and resell the minutes to businesses at a discount. It was a plumbing business, essentially. Buy bandwidth in bulk, sell it in smaller pieces, keep the difference. Waldron and Rector were soon joined by 2 more partners, Bill Fields and David Singleton. Together, the 4 of them worked out over coffee exactly how a WATS line could be resold piece by piece to smaller businesses. They called their idea long-distance discount service. A waitress serving their coffee that morning is credited with suggesting the name. The man who would turn that napkin into an empire was not in the room that day. Bernard Ebbers was born in Edmonton, Alberta, in 1941, into a working-class Canadian family that moved often and never had much spare money. He was not a natural student and never claimed otherwise. He struggled through school, took work as a milkman, rising before dawn in temperatures that dropped to 30 below zero, and it was that particular kind of cold, more than anything else, that eventually pushed him south. A basketball scholarship took him to Mississippi College, a small Baptist school in Clinton, Mississippi, the same small town that would, decades later, host the headquarters of a multi-billion-dollar company with his name attached to it. He stood 6'4", played forward, and graduated with nothing more exotic than a physical education degree. After college, he taught school and coached basketball in rural Mississippi for several years, work that paid little and led nowhere in particular. Then, with no background in construction, hospitality, or finance, he borrowed money from a small circle of friends and opened a single motel. It should not have worked. He had never run a business of any kind before. But the motel succeeded, then multiplied into a small regional chain, and through the 1970s it generated a modest, steady local fortune. Ebbers was known locally as a man who could be trusted with other people's capital. He had confidence, an appetite for risk that most men in his position simply didn't carry. That instinct built the motel chain. Ebbers did not found long-distance discount service. He rescued it. Within 6 months, LDDS was turning a profit for the first time. Its very first paying customer had been the University of Southern Mississippi. He arrived at the office in faded blue jeans and cowboy boots instead of a suit. He was a deeply committed member of a Baptist congregation, often opening corporate meetings with prayer. A country boy who happened to also be one of the most aggressive deal-makers in American business. A discount long-distance reseller in the mid-1980s did not have a product you could hold. It was thin-margin, unglamorous work, dependent entirely on volume, and it was also brutally competitive. LDDS very nearly didn't survive. Ebbers understood something his competitors didn't. In a business built entirely on volume, the fastest way to grow volume was not to win customers one at a time. It was to buy the companies that already had them. Beginning in the late 1980s, Ebbers went on one of the most aggressive acquisition campaigns in history. In 1989, LDDS issued its first public stock offering, giving Ebbers a currency, shares, that he could use to buy companies without needing cash up front. Over the following years, LDDS acquired more than 60 other communications firms. He reportedly named his personal boat Acquisition. It wasn't subtle, and it wasn't meant to be. The first true test came in 1992, when LDDS outbid both Sprint and AT&T, companies many times its size, to win a $720 million acquisition. It was the moment the industry stopped seeing LDDS as a regional reseller and started seeing it as a genuine threat. 2 more major purchases followed within a year of Metromedia Communications and Resurgence Communications Group, both completed in 1993, each one adding fiber routes and customers that LDDS could fold directly into its existing network rather than building from scratch. In 1994, the company reached further still, acquiring IDB WorldCom and, with it, its first meaningful footprint outside the United States. By 1995, the company had grown so far past its origins that the name no longer fit what it had become. Long-distance discount service became WorldCom Incorporated. That same year, it bought Williams Telecommunications Group for $2.5 billion, adding roughly 10,000 miles of fiber optic cable and 1,000 miles of microwave transmission facilities to a network that a decade earlier had consisted of nothing more than a handful of leased lines. A country idea now controlled physical infrastructure stretching across entire states, capable of carrying voice and data traffic for the largest corporations in America. By the middle of the 1990s, WorldCom made the move that would carry it into an entirely different league. It acquired UUNet Technologies, one of the small handful of networks that formed the actual backbone the rest of the Internet connected to. Then, in 1997, WorldCom did something almost nobody in the industry believed was possible. British Telecom had already agreed to buy MCI Communications, but Ebers walked in with a counteroffer near $37 billion and simply outbid the British giant. Analysts called it the largest corporate merger in American history to that date. The press called Ebers a swashbuckling deal-maker. WorldCom projected the combined firm would carry a quarter of the entire American long-distance market. The merger closed in September 1998, forming MCY WorldCom. The world was in the grip of the dot-com boom, and a company that owned both telephone lines and the Internet's backbone was exactly what every investor wanted to own. Behind the acquisitions and the stock price, there was a genuinely enormous physical operation running underneath all of it. WorldCom's network operations centers monitored the flow of billions of phone calls and data packets crossing fiber routes across the entire country. Technicians spliced glass fiber thinner than a human hair, working in cramped equipment huts and roadside cabinets at all hours, keeping a network running that most of its own customers had no idea existed in any physical form at all. UUNET alone, by the end of the 1990s, was carrying a share of the Internet's core traffic large enough that outages on its backbone could slow down websites for millions of people. It was infrastructure work, unglamorous and largely invisible, holding up a stock price that behaved for years like it belonged to a much flashier kind of business. In October 1999, 1 year after swallowing MCI, Ebers announced he wanted to do it again, a $129 billion merger agreement with Sprint that would have created the largest telecommunications company on Earth. WorldCom's stock hit its all-time peak that same year, $64.50 a share, giving the company a market value of roughly $180 billion and a spot as the 14th most valuable company on the planet. Ebers appeared on business magazine covers as a visionary. He had built from a napkin and $650,000 borrowed 16 years earlier, something worth more than General Motors. By the turn of the century, Ebers's standing had grown well beyond the industry. In July 2001, President George W. Bush proposed him to chair the National Security Telecommunications Advisory Committee. He was, for a period of roughly 2 years, one of the most trusted men in American business, precisely the reputation that would make what came next so difficult for people to accept. Every acquisition machine needs fuel, and for WorldCom, that fuel was the next deal. But in July 2000, American and European regulators blocked the $129 billion Sprint merger outright. For the first time since 1985, Ebers had no acquisition in front of him. The timing made everything worse. The dot-com bubble was already losing air, and the telecommunications sector was heading into a severe downturn. Fixed line costs kept coming due against revenue that had stopped growing. There was a second, far more personal pressure. As the share price began sliding, Ebers faced margin calls on personal loans he had used to finance a 500,000-acre ranch, a yacht, timberland, and even a hockey team. Rather than sell his shares, Ebers turned to WorldCom's own board. Between 2000 and 2002, The board authorized a series of personal loans and guarantees so that its chief executive would not have to sell his stock. Analysts kept expecting growth. Rather than reporting a difficult, honest quarter, WorldCom's leadership chose the other path. They kept the reported numbers climbing, regardless of where the difference was supposed to be hidden. The fraud that would eventually bring the company down began modestly in mid-1999 and accelerated sharply through 2001. The man directing it was the company's chief financial officer, Scott D. Sullivan. Sullivan was young for the role and widely regarded as one of the most capable financial officers in the industry. He was the numbers man who made the deals look clean on paper after Ebers closed them. WorldCom's biggest single cost was line costs, the fees it paid to lease network capacity from other carriers. Under standard accounting rules, those fees are an operating expense, deducted from profit immediately. Sullivan's instruction was to instead record large portions of those routine operating expenses as capital expenditure. It converted real losses into paper profits simply by changing which column an expense sat in. In December 2000, a financial analyst named Kim Emai was told to allocate labor costs in a way he believed amounted to tax fraud, affecting at least $35 million in reported spending. He raised concerns, but nothing changed. By the second quarter of 2001, employees inside the finance divisions were quietly voicing worries to one another in hallways and over lunch, careful never to put anything in writing. By the fourth quarter, some were refusing to make the entries at all, and some had begun quietly looking for other jobs rather than confront their bosses directly. In one instance, Senior Finance Director Sanjeev Sethi described the discrepancies to auditors as prepaid capacity. Nobody who used the phrase seemed willing to explain what it actually meant. The person who carried out many of the actual journal entries was a mid-level accountant named Betty Vinson, a woman who taught Sunday school and was known as a safe pair of hands. When her superiors asked her to make entries she believed violated basic ethics, she objected. Her bosses reassured her it wouldn't happen again. It happened again the following quarter. Over 6 consecutive quarters, Vinson kept making the entries, each time hoping it would be the last, until she had helped shift at least $3.7 billion in expenses off the income statement. Sullivan later argued the accounting was defensible. But what almost nobody knew was that the SEC had already sent WorldCom a formal request for information at almost the exact moment the scheme was closest to being discovered. By 2001 alone, the technique had turned what should have been a $662 million loss into a reported $2.4 billion profit, a single accounting maneuver carried out by a handful of people who had no power to refuse. Meanwhile, Ebers's loans from the board kept growing. By April 2002, they had been consolidated into a single promissory note worth $408.2 million, one man's personal debt to the very company he ran. The person who unraveled it was not a regulator, not a journalist, and not one of the Wall Street analysts who had spent years praising the company's numbers. It was WorldCom's own Vice President of Internal Audit, a Mississippi native named Cynthia Cooper. Working with a small internal team that was never supposed to be looking at any of this in the first place, Cooper later admitted just how frightened she had been to tell her own parents what she and her team were uncovering, because her mother and father were so proud of what the company had done for their state and their community. What almost nobody watching this story from the outside ever learned is that the courage to keep going came from something small and private. Her mother telling her never to let herself be intimidated. advice given inside a family kitchen. Cooper's department normally handled operational audits, efficiency reviews and spending controls, the unglamorous housekeeping side of a large corporation, not forensic accounting. In May 2002, an internal audit manager working under her, Glyn Smith, came across a local news story about Kim Imai, the analyst who had raised concerns about capital expenditure allocations. Smith brought the article to Cooper. She decided, on her own authority, to move that year's scheduled capital expenditure audit forward by several months and start looking quietly, right away, rather than wait for the date already on the calendar. What her team found didn't add up from the very first pass. Cooper asked for an explanation of $2.3 billion in reported capital spending and was given documentation for only $174 million of it. The rest was attributed to line costs and prepaid capacity, a term nobody was willing to explain in language she could actually verify against the underlying accounts. Because increased activity risked alerting the people she was investigating, Cooper's auditors began working at night after the rest of the building had gone home. One of her team, Jean Morse, spent evenings combing through the system and found a $500 million entry for computer expenses logged as a capital asset with no documentation whatsoever. Within days, the team had traced $2 billion that had supposedly been spent on capital projects the previous year, but had never actually been authorized in the first place. David Myers, the controller, emailed Cooper directly to tell her the audit was wasteful. She didn't stop. On June 11, 2002, Sullivan personally asked Cooper to delay the audit until after the third quarter, a request that was itself a sign something was badly wrong. She refused, and instead took her findings straight to the audit committee. KPMG's own reviewer concluded that the accounting made sense from a business perspective, but not from an accounting one. Someone had decided the rules didn't apply to them. What almost nobody knew was that Arthur Andersen had explicitly told the board as recently as February that WorldCom's controls were effective. Two of the biggest accounting failures in history, verified as sound by the same firm within 12 months. On June 25, 2002, WorldCom told the SEC and the public it had improperly classified $3.8 billion in ordinary expenses as capital investment, wiping out every single dollar of profit the company had reported. Sullivan was fired that same day. WorldCom's shares, which had traded above $15, fell as much as 76% the moment the news broke, at one point changing hands for 20 cents apiece. On June 28, 2002, WorldCom laid off 17,000 employees, 1 in every 5 people on its payroll. Families who had never heard the phrase prepaid capacity were the first ones to lose their jobs. By mid-July, pension funds were suing to recover hundreds of millions in losses. A New York court froze the company's assets. There was nothing left worth fighting to protect. Standard & Poor's cut the company's debt rating to default. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection. It was the largest corporate bankruptcy filing in American history, listing more assets than any company that had ever gone bankrupt before it. Investors had lost roughly $180 billion in market value. Some of that money had been ordinary people's retirement savings, tied up in mutual funds that had held WorldCom stock without them ever knowing it. WorldCom's collapse looked different, quieter and lonelier. Office floors in Clinton and Ashburn gradually emptying out over successive rounds of layoffs, cubicles left half-packed, symbolizing something closer to embarrassment. From a workforce that had peaked near 88,000, more than 30,000 jobs disappeared between the scandal breaking and the company's restructuring, on top of the tens of thousands lost across the wider sector. Across the industry, more than 300,000 jobs disappeared. Equipment makers who had once supplied WorldCom's expansion absorbed layoffs and falling share prices of their own as the company stopped buying anything at all. New CEO John Sidgmore appeared before a congressional committee to explain the fraud. He pledged the company would operate to the highest ethical standard, a difficult promise to lend much credibility to. So how does a company worth $180 billion turn out to be worth almost nothing? The mechanism was never complicated. A CFO moved routine costs into a column for long-term assets, so real losses read as real profits. There was no exotic derivative, no offshore shell company, just an expense recorded in the wrong place over and over until the gap reached into the billions. What happened was not one villain acting alone. It was dozens of ordinary accountants, aware at some level that something was wrong, being asked to make entries they didn't believe in. It was Betty Vinson, discovering that reliability could be turned into a weapon against her own judgment. It was a chief executive whose personal debts gave him every reason not to ask too many questions. And it was, in the end, one small and stubborn internal audit team working night shifts so their own employer wouldn't notice, who decided that being told to stop was not a reason to stop. The scandal pushed Congress to pass the Sarbanes-Oxley Act in July 2002, a law that still governs how every publicly traded American company certifies its own books today because of entries made in Clinton, Mississippi. Betty Vinson received a 5-month sentence. Scott Sullivan received 5 years. Bernard Ebbers was sentenced to 25 years in federal prison, one of the longest sentences ever handed down for a white-collar crime. Ebbers died at his home in 2020, having insisted to the end that he had never knowingly committed fraud. WorldCom's collapse is now taught in nearly every business school as a standard case study. Here is the irony. The very fiber-optic backbone that helped push Sullivan toward fraud turned out to be the one part of the company that survived intact. It simply carries someone else's name now, folded into Verizon. WorldCom was destroyed by exactly the same instinct that had built it. They had every chance to survive an honest downturn. Someone chose instead not to let the truth catch up with the stock price. If you worked in telecommunications in Mississippi or Virginia in the early 2000s, if you remember exactly where you were the week the layoffs came, if someone in your own family carried a WorldCom badge to work for years and then, 1 week in 2002, didn't, you already know what this story cost people who never touched a single fraudulent entry. Tell us in the comments what country you're watching from, what part surprised you most, and whether anyone in your family ever went through something like this.